Okay, so welcome, ladies and gentlemen. In this video, I will break down the core concept of order flow, what order flow is in the market, and how it is relevant to the market efficiency program, and how the algorithm uses order flow to determine what price levels to reach for in its delivery. So, it's very important that you get your notes out, you get your pen right now, and take note of this, what I'm about to say. I advise you to do so for your own success through this mentorship. Order flow is the net direction of orders in the market. Order flow is the net direction of orders in the market. So, when we look at the market, you understand that every moment in time, in every single price candle, there's trading going on, and for every transaction to take place, there needs to be a buyer and there needs to be a seller. Right? So, order flow is based off the concept that for those transactions to take place, although there does need to be a buyer and a seller, there will be an imbalance on either side. It's either we'll see more buy orders hitting the market or more sell orders hitting the market. So when you take the total number of buy orders and subtract it from the sell orders, there's going to be a net direction. It's either a positive or negative. And if there are more buy orders in the market, then the market is going to reach for higher prices. Okay? If there's more buy orders in the market is going to reach for higher prices. Why? Because at the current price that the market is at, because of the large volume of buy orders, not all of them can get filled at that price level. So the market makers will look for sell orders above the market price to fill with incoming buyers hitting the market order. Now, from that you can understand that order flow is either bullish, that's the scenario like this chart we're looking at. Order flow is either bullish, meaning that order flow is meaning that order flow is dominated by buyers and the market is pushing upwards. So when the market is moving up like this, we consider that as when the market is moving up, you see how it's moving up, we consider that to be a bullish order flow market condition. Okay? And another way, the other version of the and then we have another scenario here where the market is coming downwards, right? So this is a scenario where order flow, the net direction of orders, is bearish. There's more sell orders hitting the market than buy orders. And you can see it observably with price action trending downwards. Okay? So we have bullish order flow and we have bearish order flow. So now, your next question should be how do you tell when the market is in a bullish order flow condition or when the market is in a bearish order flow condition? How can you tell by looking at the charts? How can you read a price chart and tell if the market is bullish order flow or bearish order flow? And I'm going to explain the core principle here. So you have to understand this. Let's pay attention to this flow that forms right here. Right? Let's take a look at the low that forms right here, this area. So when you observe this low, right, you understand that the low of this candle, we've just decided to start from this point. We'll start our analysis on this point. You understand that buyers buy the low, right? And you know that sellers sell the highs. So this is an up close candle, down close, up close, up close, down close. Now, this region right here, this region right here, that's the low of that candle. This is the lowest price that was reached, right? The low of this candle, which was 162.71. Now you have to assume that if buyers got in at this level, they're going to place their stops below this low, right? So let me visualize that for you. And we'll put sell stops. All right. So you know that buyers who got into the market at this low, or buyers who are now getting into the market after the price has formed this candle, getting in at this up close, at this down close, this blue candle, or getting in at the penultimate, at the succeeding up close candle. All the buyers coming to the market at this point are putting their stops where? They're gonna put their stops below this low. Meaning they expect that price should not go below this low and price should go higher so they can make some money. Now, if you observe the high of this range, so now price made this low, followed by an up close, a down close, then an up close, another up close, and then this big body down close candle, a fat blue candle. And now you have to assume that sellers obviously dominated, and that's why this is a down close candle, meaning that you already know that the close, which is down here, is lesser than where price opened at during that session. Okay, so now you have to know that sellers got into the market at this candle. And if sellers get into the market, why do sellers get into the market? Because sellers sell the high. So when this candle formed, they assume that this is a high, trading into a fair value gap. We'll talk about this later. And then price declines. So sellers are going to sell this candle, sell the close of this candle, and also sell this candle, right? And the institutions that sell this candle are going to place their own stops as well, because you remember, you place a stop to protect your position, right? So if the market goes against you, you lose a certain amount. So they, on the other hand, are placing. What are sellers? If you sell? How do you get out of the market? You gotta buy to close, right? So sellers will place what? Buy stops. So you got to, every time you see a swing point form in the market, you have to assume that below the low of that swing point, if it is low, below that swing point, they're going to be what? Sell stops. Why? Because buyers bought the low. Buyers need to protect their position. So that's why they're going to put their stops below the low. And above highs, you're going to see what? Buy stops. You're going to see buy stops because sellers sell the high. And how do sellers get out of a position? If you sell, you got to buy to close. So they're going to put stops above the high. So in terms of order flow, when you look at the market, you identify where are the buyers' stops and where are the sellers' stops. So the people who bought, where are their sell stops? The people who sold, where are their sell stops? Right. So now if you buy, you want the market to keep going up, right? So if the market keeps going up, you make more money. And if you sell, you want the market to keep going down. And if the market keeps going down, you keep making money, right? So what happens when you sell, but the market instead of going downwards, it goes upwards? What happens when you sell and the market goes up instead? You lose out, right? You get burnt. And what happens is the market reaches for your stops, right? So the market goes to a certain level and you say, oh, I can't take this loss anymore. I'm going to get out of the market. So you sell. Or if you were short in that position, the market will reach for a level higher than your entry price, and you get to a point where it's like you don't want to take a larger loss. So you buy to close. So with order flow, if order flow is bullish, this is a principle, guys. If order flow is bullish, then you want to see when the market forms a low or a swing high, you look at the stops. The buy stops should be ran out. Where sellers are getting into the market, you know that they're going to be buy stops sitting above that level. You want to see the market constantly go higher and take out all those buy stops. That is making the sellers lose. So the people who short the market at this level here and were making money as the market went downwards, when the market recovers and finds this low here and bounces back up, what happens to the people who sold here? They're losing money now. So in a bullish order flow scenario, you want to see that the buy stops of the sellers are continually run out. And you also want to make sure that the sell stops of the buyers are preserved, so the market does not go back down to touch the sell stops. Do you notice how in this example, the price after forming this low, forms this high, now we're in range. The market doesn't run the sell stops. The market doesn't take out the buyers. Instead, the market goes up higher, and who does it take out? It takes out the sellers. Boom. So we suspect that the order flow is bullish. So let's follow the move. Right? So let's follow the move. So you can see now that the market has formed a new swing. Right? So we can look at this low and look at where the market reached. All the way to this top. Now we suspect that the order flow is bullish, right? So I told you, order flow principle, when the market is bullish, put this in your notes, guys, pay close attention. You want to see the sell stops of the buyers preserved, and you want to see the buy stops of the sellers ran out. So in this swing now, let me put this aside now so we can just observe the market. If you take this low, the low from this candle to the high of this up close candle right here, this new range, right? If you take that range, where do you think the sellers got into the market? Remember I told you sellers sell the high. So sellers are going to come into the market right here, right? And that's why you see this. What do you see? You see a down close candle followed by a lower down close candle. Sellers get into the market. That is obvious. So where are they going to put their stops? Sellers put their buy stops where? Here. Sellers will put their buy stops above the market. And where do you think the buyers got into the market in this swing? Obviously, the buyers go into the market at the bottom. So you can see down here, you see up close candle, and then another up close candle, lethargic movement upwards. So buyers go into at this low. Now the order flow principle is what? You want to see the sellers get killed, and you want to see the buyers preserved. So now look at the buy stops, look at the sell stops, and where does the market reach for? The market could have very much come down here to this low, but it didn't. Instead, it rallies further. Do you see? And you can continue like this principle I'm telling you about, listen, is solid because this is what the market, this is what the algorithm uses to deliver prices. So look at the next swing. Okay, so the market retraced back downwards. So we formed this high and the market retraced back downwards, right? Now look at the next swing. Look at the next swing right here. Take from the lowest point to this high, to the high. Where did the buyers get in? Buyers buy the low. Buyers are going to pull what? They're going to put their sell stops under. Where did the sellers get in? Sellers got in at the high. Sellers sell the high. Where are they going to put their buy stops? Above the high. Where does the market reach for? The market could have very much come down here, but it didn't. Instead, it bounced back up. And it went to take out all the people who sold this candle and sold the following down close candle. They're losing money now. When the market reaches above this high, they're losing money now. And it continues going. So you can take that range anywhere. Look at this swing right here. Consider the next swing from this low to this high. Where buyers get into the market, buyers buy the low. So you know that there are buy stops under that. Sorry, there are going to be sell stops under that low. Where did the sellers get into the market? Sellers sell the high, so they're going to be buy stops above that high because sellers need to buy to close their position. Where does the market reach for? The market reaches for the buy stops, and it protects the sell stops. The sell stops don't get touched. The market could have dipped down and the sellers would have continued to make money, but it didn't. Instead, the buyers are the ones making money because the price went higher. And with that being said, you can look at this. Do you see what I'm saying? So a new level formed. So do you see how at every high there are buy stops sitting above that high? At every low there are sell stops sitting below that low. And where does the market reach for? Do you see how the market doesn't take out this low, but it's constantly the first one, this high at 331.91, it gets clipped. Price goes to form another high. Price goes to form another high at 382. At 379.43. $379.59. And look at this. This is the new high that's formed. Price comes back down. Finds a low. Price does what? It goes higher than that. Takes out the buy stops. And you can keep going, So this is what I'm trying to say. So that is the principle for bullish order flow. Now you probably wonder, so how do we know when bullish order flow is changing to bearish? When do we suspect that bullish order flow is changing? So we know that bullish order flow scenarios, the price is supposed to take out the highs and preserve its lows. Okay? So in a scenario where the price fails to take out the high, and then takes out a low, how do we suspect that the market is still bullish? And for instance, I want you to look at this price action. So in this scenario right here, I want you to see that we have this impulse swing upwards, and then we have a retracement into the market. So price moves lower after making that swing, and then from that low, price reacts, another impulse swing higher, and then price makes this low. Rallied upwards, but failed to go. It could have gone beyond this high, but it failed to go beyond the high. Instead, we fell lower. Right? So price fell lower. So now you're probably wondering, based off of the principles of order flow, right? Based off of the principles of order flow, we saw the first swing up, the low and the high. The low was preserved because price didn't go to take out this low. Instead, it went to take out the high. It went higher. So the high is taken out, low is preserved. Check. We're still bullish. Situation where price comes, retraces again. But remember the principle, lows are preserved, highs are taken out. So we expect buyers will come into the market, and they do. They push it up again. Well, price fails to take out that high, instead retraces and takes out this low. So now, same world, are we still bullish? That's the big question. Well, the answer is no. We are not bullish. We suspect that price should become bearish. So when that low is violated, you know that low that we expect to be preserved, when it gets violated, we suspect that price action is turning bearish. But there is a condition, there is a clause to that. And pay attention, because this is very important. That clause is, if price action is still bullish, right? Let me take off this makeup from the chart so you can see. A situation like this. Boom, 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 boom. Right? So the market has shown us a market structure shift by taking out this low, which is not supposed to happen if the market is bullish. So if the market is still bullish, the clause is we must see a lethargic movement upwards that goes to take out the previous high that was made. So if the market is in a bullish order flow condition and runs out its previous low that is supposed to preserve, then we expect that the market should swing upwards lethargically and take out the old high. Now, if the market fails to do that, then order flow is bearish. Play that back and listen to it over and over again. So in this market condition, when we look at this chart over here to our left, this price action, when price went lower than this low, right? This low that was formed here, when price, the low of this candle was 823.52. When price went lower than that, because this candle's low was 821.10, what happens afterwards? We see a sharp lethargic move upwards. So that confirms that we're still bullish on Netflix.